How about counter-trend trading strategies in futures trading? This involves taking positions opposite to the prevailing trend in anticipation of a reversal. It's a riskier strategy as it goes against the market momentum, but can be profitable if timed correctly. What is the strategic goal of counter-trend trading strategies in the context of futures trading? The strategic goal of counter-trend trading strategies in futures trading is to capitalize on trend reversals. These strategies focus on identifying and trading against the prevailing market trend, aiming to profit from the points where the trend begins to reverse direction. The primary goal of counter-trend trading in futures is to profit from anticipated reversals in the prevailing market trend. This strategy is typically aimed at capital appreciation through speculation. Traders using this approach seek to identify potential turning points in the market, taking positions opposite to the current trend in expectation of a reversal. How do counter-trend trading strategies perform under various market conditions? Counter-trend trading strategies are ideal for potentially overextended markets where a current trend might be nearing its end. These strategies can be effective when a market shows signs of exhaustion after a prolonged trend, indicating a potential reversal. Counter-trend trading strategies are most effective in market conditions where a trend may be overextended and thus ripe for a reversal. This can occur in both volatile and trending markets. The strategy may be less effective in markets where trends are strong and show no signs of weakening, as the risk of misjudging the trend reversal is higher. What risk factors are involved in counter-trend trading strategies? There are higher risks involved in counter-trend trading strategies due to going against the market momentum. Predicting trend reversals can be challenging and carries the risk of entering trades prematurely if the prevailing trend continues longer than anticipated. Counter-trend trading is inherently riskier as it involves going against the prevailing market momentum. The primary risk is entering a trade too early before the trend actually reverses, which can lead to significant losses if the trend continues. Traders must have strict risk management practices, including tight stop-loss orders, to mitigate the potential losses from incorrectly timed entries. What are the potential rewards of employing counter-trend trading strategies? The potential rewards of employing counter-trend trading strategies come from profiting from the early detection of trend changes. If executed correctly, these strategies can yield significant profits by capturing the initial stages of a new trend. The reward potential in counter-trend trading lies in the ability to identify and capitalize on trend reversals before they become apparent to the majority of the market. The best-case scenario is accurately predicting a market top or bottom and entering a position that profits from the subsequent trend reversal. However, traders should understand that accurately timing reversals is challenging, and the average expected return can vary significantly based on market conditions and the trader's skill. What considerations should be taken into account when implementing counter-trend trading strategies in futures trading? Key considerations when implementing counter-trend trading strategies include accurately identifying reversals and effectively managing risks. This involves using technical and fundamental analysis to detect signs of a trend reversal and employing strict risk management techniques to minimize potential losses. Implementing a counter-trend trading strategy effectively involves utilizing technical analysis tools such as oscillators like RSI or stochastics divergence indicators, or reversal candlestick patterns to identify potential trend reversals. Carefully selecting entry points that signal a high probability of trend reversal while being aware of false signals. Setting precise stop-loss orders to manage the risk of the trend continuing against the position. Monitoring macroeconomic factors and market news that could influence trend stability and the likelihood of reversals. Being prepared for the psychological challenges of going against prevailing market sentiment and having the discipline to adhere to pre-planned entry and exit strategies. Counter-trend trading in futures requires a high level of market expertise, the ability to interpret technical signals accurately, and a strong risk management discipline. Traders should approach this strategy with caution, understanding its risks and rewards, and ensuring their trading style and risk tolerance align with the demands of counter-trend trading.